Welcome to this explainer. For years, folks in the C-suite across the global banking sector have been prepping for Basel 3.1 under the assumption of, global regulatory standardization. The dream was this unified, level playing field. But if you're managing cross-border operations between the European Union and the United Kingdom today, you already know that illusion is completely shattering. The English Channel is becoming a major regulatory fault line, proving that in banking, water is definitely thicker than standardization. The variations in how the EU and UK are actually implementing these reforms will fundamentally alter capital planning, risk modeling, and basically overall bank profitability.
Okay, let's dive into our roadmap for today. First, we'll cover the Basel baseline, then output floor timelines. After that, we'll hit credit risk deviations, followed by an SME case study. Then we'll look at the capital impacts, and finally, wrap up with an executive action plan.
Section 1. The Basel Baseline, a shared foundation.
So, right at the heart of these reforms is the output floor. This is essentially a mandatory rule designed to stop banks from being, let's say, overly optimistic with their own internal risk models. Simply put, it ensures that the capital calculated using a bank's internal models absolutely cannot drop below 72.5% of the risk-weighting asset requirements calculated under the standardized approach. Now, both the EU and the UK agree on the 72.5% destination. Where they violently disagree, however, is on exactly how and when we get there.
Section 2. Output floor timelines compared. The first divergence. The strategic headache for cross-border banks is very, very real. The divergence is incredibly stark. The EU begins its phase-in earlier in 2025, starting at a 50% floor, but they actually stretch certain transitional relief measures all the way out to 2032. The UK, on the other hand, delays the start entirely to January 1, 2026, kicking off at 55%, but then they ramp up much faster, demanding full compliance at the 72.5% mark by 2029. So if you're a bank operating in both regions, how do you optimize capital when your models are fighting against two completely misaligned schedules over the next 7 years? It's a massive challenge.
Section 3. Deviations in credit risk. The standardized approach.
You can really see the contrasting regulatory philosophies at play when we get into the details. The UK is heavily targeting risk sensitivity, while the EU is relying a lot more on complex carve-outs to protect certain sectors. For example, the SME support factor, which is designed to make lending to small businesses cheaper, that's fully retained in the EU. But the UK regulator, the PRA, removes it entirely from Pillar 1 baseline minimums, opting instead to make adjustments later in the firm-specific Pillar 2A requirements. We also see this exact same dynamic with infrastructure projects. The EU keeps the support factor, while the UK replaces it with a much more risk-sensitive project finance approach.
And this philosophical split? It spills right over into the internal ratings-based, or IRB, approaches. When we're talking about retail exposures, the EU has implemented a 0.05% probability of default floor. The UK, leaning into a distinctly more conservative posture, opts for a 0.1% probability of default input floor. Now, I know it might sound like a minor fraction, but it is literally double the EU's requirement. Across a massive retail banking portfolio, that difference directly translates to millions in unexpectedly locked-up capital.
Section 4. SME case study. Theory into practice.
Let's put this into practice. Imagine your institution is underwriting a mid-sized loan to an unrated manufacturer. In the EU, unrated corporates generally face a 100% risk weight. However, the EU allows a specific carve-out for banks using IRB models. If the probability of default is incredibly low, you can apply a 65% risk weight. Now in the UK, it is a completely different story. The SME support factor is just gone from Pillar 1, and they get hit with a flat 85% risk weight instead.
To really grasp the nuance here, think about the EU's regulatory phrasing. The EU intentionally builds in this flexibility. By allowing a 65% risk weight if the probability of default is below 0.5%, they're actively trying to ensure that high-quality, unrated corporate lending isn't unnecessarily choked off by overly rigid capital requirements. It's a very deliberate carve-out.
Now contrast that with the UK's strategy. The UK regulator absolutely knows that removing the SME support factor could suddenly and severely punish banks for SME lending. So their strategy is to mitigate it by replacing it with a firm-specific Pillar 2A adjustment. This brilliant little maneuver allows the UK to maintain an optically strict standard in Pillar 1 while they actively manage the actual capital burden behind the scenes to avoid inadvertently crushing the domestic SME economy.
Section 5. Impact on capital requirements. The broader picture.
A really prime example of the broader impact is the treatment of credit valuation adjustments, or CVA, which is essentially the capital you hold against counterparty default risk. The UK's strictness here is going to squeeze capital noticeably faster. Why? Well, the EU continues to exempt trades with pension funds, non-financial counterparties, and sovereigns from CVA capital charges. The UK PRA, however, has totally revoked these exemptions for new trades, and they've introduced transitional arrangements to phase them out for legacy trades. So if you're operating in London, you now have to hold capital against trades that are completely exempt in Frankfurt or Paris.
The absolutely crucial takeaway here is that capital pressures are hitting UK institutions significantly earlier in quite a few areas. For off-balance sheet items like unconditionally cancelable commitments, the UK mandates a strict 10% credit conversion factor, meaning 10% of that commitment must have capital backing it immediately starting in January 2026. The EU takes a much more lenient stance, allowing institutions to apply a 0% CCF to these exact same commitments all the way until the end of 2029. Furthermore, if you're looking at market risk under the Fundamental Review of the Trading Book, or FRTB, the UK's internal model pre-approval process is significantly more rigid and demanding than the EU's approach.
Section 6. Action Plan for Executives, Strategic Next Steps.
So for you C-suite leaders managing a cross-channel footprint, here is your immediate action plan. Number 1, your IT infrastructure requires an immediate upgrade. You simply can no longer rely on a unified system. Your architecture has to be capable of processing entirely different risk-weighted asset calculations simultaneously. Number 2, revise your capital planning models today. The misaligned output floor schedules mean your capital optimization strategies for 2026 will look fundamentally different depending on the jurisdiction. And number 3, you absolutely must master the interconnectedness of these risk frameworks. A change in Pillar 1 in the UK affects your Pillar 2A buffers, while a carve-out in the EU alters your entire long-term capital trajectory.
Basel 3.1 is absolutely no longer a story of global harmonization. It is a story of strategic adaptation. The rules of the game are fragmenting right in front of us. The institutions that thrive over the next decade won't just be the ones that understand the math. They'll be the ones whose operational agility allows them to seamlessly bridge these regulatory gaps. So, as you look at your own capital planning for the years ahead, you really have to ask yourself, is your institution agile enough to navigate the divergence? Thank you for joining me for this explainer.